A firm introduces a rule inside its protection system. Customers must accept a standardized safety and insurance contract. The rule defines how risk events will be compensated. The rule also defines how liability is assigned after an incident. The decision looks procedural. It appears inside a customer agreement page. It appears inside underwriting documents. It appears inside internal compliance checklists. Protection becomes the visible product. Risk management becomes a background function. The rule contains a clear reward signal, lower immediate operational cost for the firm, reduced liability exposure after failure events. The rule contains a clear penalty signal, direct blame exposure during safety incidents, compensation payouts when fault attribution is confirmed. Inside this rule structure, a firm faces a micro decision: invest heavily in prevention capacity or rely on contractual protection layers. Prevention requires immediate engineering spending. Prevention also requires slower product rollout cycles. Protection contracts require less operational investment. Protection transfers part of risk to customers. The cost difference appears immediately in quarterly reports. Prevention spending increases operational costs today. Liability exposure may appear much later. The time horizon becomes uneven. Immediate cost. Delayed liability. A product safety review meeting appears on the internal calendar. Engineers request expanded testing capacity. Operations reports tight launch deadlines. Legal reminds the team about contractual protection coverage. The rule already allows liability transfer. A decision is recorded. Testing scope remains minimal. Insurance coverage remains unchanged. No violation occurs. The system rule already permits this configuration. The product ships on schedule. Inside the customer environment, another decision occurs. A buyer must choose between two products. One product advertises strong protection coverage. Another advertises deeper engineering reliability. Protection coverage is clearly documented. Engineering reliability remains difficult to observe. Hidden information shapes the choice. The buyer selects the product with formal protection. The transaction is logged in the firm's sales dashboard. Reported customer safety coverage increases. Operational safety investment remains unchanged. This difference becomes visible in internal reporting. Protection coverage ratio rises across the customer base. Engineering safety capacity grows slowly. A measurable distortion begins to appear. Reported protection metrics improve. Operational risk mitigation capacity does not. Two groups now interact under different assumptions. Customers assume protection signals lower underlying risk. Firms understand protection signals transfer liability instead. Coordination begins to break. Customer expectations increase after reading protection clauses. Operational teams maintain the same safety infrastructure. Support teams receive more incident reports. Incident volume increases slowly each quarter. The insurance structure absorbs early losses. Short-term stability holds. Inside executive review meetings, another dashboard appears. Protection enrollment rate becomes a performance metric. Managers notice a pattern. Higher protection enrollment correlates with lower liability exposure. The metric becomes operational guidance. Protection enrollment targets enter quarterly review documents. Hiring decisions begin referencing protection metrics. Teams specializing in coverage structures expand. Teams specializing in preventive engineering remain flat. The system shifts quietly. Protection coverage expands across the industry. Firms compare liability exposure ratios in market reports. Competitors observe similar patterns. The strategic adaptation spreads. Each firm prefers protection structures over prevention investment. Risk handling becomes contract management. Safety management becomes a compliance process. Operational artifacts multiply. More liability clauses appear in contracts. More insurance pools emerge across the market. More dashboards track protection participation. Engineering reports remain unchanged. Protection metrics rise again. Incident rates rise slowly as well. The distortion becomes visible. Reported safety coverage expands. Operational risk capacity remains constrained. Insurance pools absorb increasing losses. Costs distribute across the entire customer base. Risk becomes shared rather than reduced. The system now stabilizes around this structure. Firms maintain protection layers as primary defense. Customers rely on protection promises after incidents. Prevention remains secondary. The market reaches a new equilibrium. Risk persists. Liability circulates through the system. Protection coverage metrics continue rising across quarterly performance dashboards. Senior reports highlight expanding protection participation across the customer base. Incident reports appear separately in operational risk logs. The two charts rarely share the same slide. Protection enrollment becomes a standard KPI inside management reviews. Department scorecards reference protection adoption targets. Promotion discussions begin referencing these numbers. Hiring criteria gradually reflect the same structure. Job postings request experience in liability framework optimization. Interview questions focus on coverage structuring and contract safeguards. Fewer candidates are evaluated on preventive engineering capacity. A pattern begins forming in recruitment pipelines. Teams grow around coverage administration. Preventive infrastructure teams remain small. Operational playbooks update quietly. Customer onboarding scripts emphasize protection enrollment steps. Sales checklists highlight coverage explanation before product usage guidance. A new training document circulates internally. It explains the correct procedure after safety incidents. First, verify contract coverage status, then route claims through insurance channels. Documentation grows thicker. Internal norms stabilize around these procedures. Incident handling meetings reference the same playbook each time. Contract verification becomes the first operational checkpoint. Prevention discussions appear later in the agenda. Time horizon differences widen across departments. Coverage teams see immediate performance gains each quarter. Preventive improvements require longer investment cycles. Quarterly reporting reinforces the faster signal. Immediate metrics dominate performance summaries. The hiring pattern accelerates this difference. More specialists analyze liability distribution across contracts. Few specialists analyze underlying failure probabilities. Operational growth amplifies the imbalance. Customer volume increases each year. Coverage processing systems scale through automation tools. Preventive engineering capacity grows slowly by comparison. Oversight capacity struggles to keep pace. Risk review teams receive larger incident data sets every quarter. Manual investigation processes remain unchanged. Backlogs appear in internal review queues. Insurance pools distribute early losses across participants. Individual incidents no longer produce visible shocks. Short-term stability continues. Cross-actor feedback loops begin strengthening the structure. Customers read protection coverage before evaluating operational reliability. Firms observe this behavior through sales analytics. Marketing materials adjust accordingly. Protection language becomes more prominent in product documentation. Engineering reliability remains buried inside technical appendices. Sales teams report improved conversion when protection clauses appear early. Another dashboard update follows. Protection coverage rates climb again. Operational capacity remains unchanged. The distortion between representation and capacity grows wider. Claims processing infrastructure expands to handle higher volume. Engineering infrastructure does not expand at the same pace. Scaling amplifies the difference further. Larger customer pools dilute visible consequences. A single failure spreads across many policyholders. Costs distribute quietly across the system. System-level decay becomes harder to isolate. Insurance pools smooth volatility across reporting periods. Losses appear manageable on aggregate spreadsheets. For a moment, the pattern appears uncertain. Some quarterly reports show declining incident ratios. It becomes unclear whether risk is actually increasing. The numbers appear temporarily stable, but operational logs continue accumulating unresolved cases. The backlog chart grows slowly each month. Playbooks adapt to maintain throughput. Standardized claim processing templates reduce investigation depth. Incidents move faster through administrative pipelines. More cases close without full root analysis. Speed replaces diagnostic depth. Protection coverage remains the visible metric. Hiring continues reinforcing the same capability set. More analysts interpret coverage ratios across market segments. Fewer engineers model failure propagation across product systems. Training sessions replicate the same operational emphasis. Employees learn claim routing before preventive assessment procedures. Norms solidify across departments. Protection enrollment becomes the default success signal. Internal meetings begin referencing historical coverage growth curves. The curve becomes a benchmark for progress. Managers align departmental targets around the same indicator. Operational dashboards synchronize around protection participation rates. Engineering metrics appear less frequently in leadership briefings. Oversight tools struggle with expanding system complexity. Incident classification rules remain unchanged despite growing data sets. Investigators rely increasingly on summary indicators. The system continues expanding. Each additional customer enters the same protection framework. Each additional incident enters the same insurance pool. Costs disperse further across participants. Risk remains present inside the system, but responsibility circulates across contracts instead of operations. The pattern now appears normal across the industry. Protection coverage remains the dominant indicator in quarterly reports. Risk engineering capacity remains limited inside operational teams. Customers continue selecting products through visible protection signals. Firms continue optimizing liability distribution through contract structures. Insurance pools absorb growing incident costs. Each participant pays a small fraction. The system remains stable. Incident volume slowly rises inside internal logs. Protection participation rises faster. The two curves rarely appear on the same dashboard. Operational capacity never expanded enough to match system growth. But liability exposure never concentrated enough to trigger collapse. Risk does not disappear. It circulates. Contracts route responsibility through the network of coverage pools. Costs spread across thousands of participants. Failures distribute quietly across reporting periods. Protection coverage continues expanding. Prevention capacity remains secondary. The system holds its balance. Risk exists everywhere. Liability exists nowhere specific.